You left the country. The tax bill didn't. Imagine this. You planned your move abroad carefully. You researched the rule everyone talks about. Spend fewer than 183 days in your home country in a given year, and you are no longer considered tax resident there. So you leave. You track every single day. You stay well under the limit. You start building your new life. Then, months later, a letter arrives. It's from the tax authority in the country you left. They consider you still tax resident. They may ask for details of your income, including income earned while you were abroad. Still in your name, still available to you. Bank accounts, investments, a few clients, a salary still being paid locally. Your spouse still registered at that address. You counted the days perfectly, but the days were never the whole story. The 183-day rule is real. It appears in tax frameworks across many jurisdictions, and for many people, it works as a useful reference point. But it is exactly that, a reference point, not a complete answer. Tax rules vary by country, so the goal here is not to give you one universal rule. It is to show you the framework you need to understand before you move. Today, what tax residency actually means, why the day count often tells only part of the story, and what to look at before you leave one country or arrive in another. Tax residency is a legal status. It determines which country, or in some cases, which countries, has the right to tax your income. It is not the same as citizenship, it is not the same as nationality, and it is not determined solely by how many nights you spend somewhere. Most countries assess residency through a combination of criteria. Common questions include: do you have a permanent home available to you in this country? Where are your closest personal and economic ties? Your family, your employer, your bank accounts, your investments? How much time do you spend here compared to anywhere else? Are you formally registered with local authorities, healthcare systems, or on official records? Tax authorities are looking at where your life is actually anchored. The 183-day rule sits within that assessment. It does not replace it, and it is worth noting, in some cases, citizenship or nationality can create additional obligations, even when your tax residency points somewhere else. That is a separate layer of complexity, one we will flag here, though it goes beyond what we can cover in a single video. So why is the 183-day rule so widely cited? In many countries, 183 days is an important threshold, but residency often also depends on other ties or tests. The problem comes from the reverse assumption that spending fewer than 183 days automatically ends tax residency. In many jurisdictions, that is not how the rules operate. Staying under 183 days may mean you do not meet one particular threshold, but you can still be considered resident because a home remains available to you, because your family is there, or because your economic interests remain concentrated in that country. Some jurisdictions also use rolling or multi-year presence formulas rather than a single-year day count. The 183-day rule is a useful benchmark. Treating it as your complete exit from a country's tax system without reviewing anything else is where many people encounter problems they did not anticipate. Depending on the jurisdiction, here are the additional factors that can shape your tax residency status. Permanent home. In many countries, having a property available to you, owned or rented, occupied regularly or not, is treated as a significant indicator of residency. Available means available. Center of vital interests, a concept used in many frameworks and international treaties. It refers to where your personal and economic life is most deeply connected. Family, finances, work, the country with the strongest overall connection often takes precedence. Family ties. A spouse or dependent children living in a country can be a significant factor in assessing your own residency. And in many jurisdictions, family ties contribute to the overall picture alongside your day count. Economic interests, where your income is earned, where your investments are held, where your bank accounts sit, where your clients pay you. These connections can matter regardless of where you physically spend your time. Habitual abode. Some frameworks focus on your regular, settled pattern of living rather than a simple yearly tally of nights. Employment, business activity, and local registrations. A contract with a local employer, a registered business, An active local address or voter registration can all reinforce residency in the eyes of tax authorities. No single factor is necessarily decisive. Authorities assess the combination, and the weight given to each element varies by country. This is where situations can become more complicated. It is entirely possible, and it happens more often than people expect, for two countries to simultaneously consider you tax resident. Your former country may point to your home, your family, or your income sources remaining there. Your new country may point to your physical presence and new local ties. Both may be correct under their own domestic rules. This is called a dual residency situation. Without a mechanism to resolve it, the same income could potentially be subject to tax in both places. That mechanism, where one exists, is the double tax treaty. Double tax treaties are bilateral agreements between two countries, designed to reduce or resolve situations where the same income could otherwise be taxed by both. Many treaties closely track the OECD model and include what are called tiebreaker rules. These work as a sequential test. Where is your permanent home? If both countries have one, where is your center of vital interests? If still unclear, where do you habitually live? And so on. In the next video, Double Taxation, Explained for Expats, we go into how those tiebreakers work in practice and what they mean for real decisions. For now, treaties can offer meaningful protection, but only if you understand what they say and take appropriate steps. Before you move abroad, or if you have already moved and want to review your position, work through these 7 checks. 1. Count your days. Use a reliable method. A calendar, a travel app, a spreadsheet. Day counts matter. They are just not the only thing that matters. 2. Check your home ties. Do you still have a property available to you in the country you are leaving? Even if unused, it may be a factor. 3. Map your income. Where is your income earned? Where is it paid? Where are your clients, your employer, your investments? Each stream may be treated differently. 4. Update registrations. Deregistering correctly in the country you leave and registering properly where you arrive is an administrative step that matters more than most people realize. 5. Keep evidence. Maintain records of where you lived, worked, and spent your time. If your residency is ever questioned, documentation can be decisive. 6. Check the treaty. Does a double tax treaty exist between the two countries involved? If so, understand what it provides, particularly how it resolves dual residency situations. 7. Plan before the move. Many tax complications arise from decisions made before people fully understood the rules. A consultation with a qualified international tax advisor before you leave is often the most practical step you can take. Tax residency is not a number on a calendar. It is a legal status built from multiple factors: your home, your family, your income, your connections, your time. Understanding that framework is the foundation for managing your tax position properly when you live across borders. In the next video, we go deeper into double taxation, how treaties resolve conflicts in practice, and what expats actually need to think about. If this was useful, subscribe so you do not miss it. And if you have questions or situations you would like us to cover, leave them in the comments. See you soon.